Oh, thanks so much for joining today. I'm Natalie Levy, the founder of She's Independent, and I'm really excited about the topic that we are focused on today. I have a background spanning investments, and I run an investment group under She's Independent, and I've led numerous workshops on negotiating, and it's a topic that I really enjoy. And it's something that so many friends and colleagues over the years, because they didn't have investment backgrounds, know nothing about. So it's something that we're starting to present more and more on, and really excited to see all the interest today. In terms of investment track record, because I do think it's relevant to talk about when we're talking about these topics, I've been angel investing for a bit over a decade, and I also have some institutional finance background. I have a number of exits in my portfolio and some really high returns on some of my early companies that I invested in. I mention that, of course, because investing and thinking about equity ownership, you want to have some sense of what is the value of the investment, right? And we'll get into that. I'm really going to focus in on key and fundamental topics today, but we have a lot that we can show you out of today if you want to get further involved. I also want to make a quick mention around my background includes going through some really tough things in my family. And part of, the work I'm doing at She's Independent and why I'm so excited to give back and talk about issues like gender equity, how do we really impact power dynamics and get more diverse individuals on boards and talking about investing concepts, is we went through a few deep losses in my family. And that was something where it basically had me pivot what I was doing, what I was focused on, because I wanted to do something that was more fulfilling and something that really allowed me to really tap into these skills where I wasn't just working for a bigger corporate machine, but doing something that I was really passionate about. So let's take a quick look at the agenda. We have a lot to cover, and depending on how much time we have, I want to leave time for Q&A. You can always drop questions in the chat in real time, and I may get to those, or we may actually wait for those to address them later. But in terms of what we're going to cover, first, I just want to do a check-in. Why did you show up? We're going to talk about equity basics. What is equity? How do you start thinking through the different levers of equity? How do you think about evaluation? You can't negotiate something if you don't understand the value. We're going to talk about what is negotiable, potentially, in an equity comp package. And we're just going to talk about that framework of negotiation and really dig into it for a bit. Finally, we'll close with tips and exercises, but of course, also leave time for that Q&A. So please think about being interactive. I want to know who's on. I want to know what your questions are. And we'll start with, it's great to meet you. And what are you looking for today? So again, if you feel called to come off of mute, you are more than welcome to speak up. You can also drop something in the chat. I'll give you some suggestions. Maybe you are negotiating a new employer comp package. Maybe you have equity with your employer and you don't know what the value is. Feel free to drop something in the chat or speak up if you like. I'll give you a minute. Great. Looking for maybe your first tech role. So there will be an equity package, we presume, and we'll talk about that. Great to skill up, whether it's a new role, whether it's about negotiating for your next role or just understanding what you have. Great, we have another someone chiming up in the chat, looking at a board or startup role. So of course, negotiating and understanding how that package works is really relevant. Great, we have another individual saying you are negotiating to make a change within your role and the comp. Love that. You can always make changes even when you're already in the role. Another person says looking to better understand common tech equity packages. All right. Thanks for weighing in. We'll get started. Oh, was somebody going to say something? Nope. Okay. We'll keep going. So in terms of, equity, the term equity, everyone hears the term DEI, right? All the time. It's this kind of hot term and everyone's using it in some capacity. But when you really dig into the equity piece, there's different ways you can define it. But I just want you to think about ownership. I want you to think about say and participation. And I want you to think about authority to change things. So one of the things that She's Independent that we're really excited to talk about is not just the wage gap where we all know that white women, for example, are earning 83 cents on the dollar. Women of color are earning way less compared to that dollar earned by a man. But when you look at things like the equity ownership gap and the VC financing gap, it's even more drastic, right? We're not talking about 80 cents on the dollar. We're talking about 43 cents on the dollar, what women own in terms of equity for every dollar earned by a man. And less than 3% of financing or funding goes to these women-owned businesses when we're talking about VC and venture capital financing. Less than 0.5% to Black-owned women businesses. And so these are really important topics to be talking about, right? It's power dynamics, it's understanding how to actually have the conversation, how to engage, and how to basically make sure that you're not getting just 43 cents on the dollar, but that you're getting $1 or more. So I am going to spend a little bit more time talking about what is equity. So when you start working with a new employer, or maybe with your existing employer, if that company is private, if they are giving out equity, and they may have a comp sharing plan that has something to do with even if it's publicly traded, but what we're really going to talk about today is if it's a private company and they're giving you shares or options or ownership in that business, what does that mean? So a typical equity package, let's take a step back. A typical comp package includes cash comp, meaning what are you going to be paid, base salary, what are you going to be paid on top of that for bonus? And then there may be this option for equity. And equity can come in different forms, which we'll talk about on the next slide. But at a high level, it's good to understand what is equity. And when they give it to you, what does that mean? And so equity really is ownership. You are basically given the opportunity to participate in upside of that business. And so if they give you equity worth 0.5% or 0.1% or whatever small amount, de minimis amount they may give you, and we'll talk about negotiating that, if the company goes from a 10 million valuation to 100 million or $1 billion, you have massive appreciation on upside. And if you have substantial equity, the upside really can be real. I say on this slide here, there's a possible liquidity event because you won't always see liquidity or an exit on the back of your equity. But if there is a liquidity event, if the company gets acquired, if the company goes public, if the company goes through a bigger financing round and you have the option to take liquidity, there's all these different avenues where you can make money on that illiquid or that equity that basically is something that provides ownership in the business. Something to think about is it's often cheap or inexpensive for the employer to give you this. Oftentimes, not always. We'll talk about that. But just thinking about equity, I like to think about it as I don't want to just work for equity unless maybe I'm very aligned and maybe it's a project that's very impactful and it's something that, they can't pay me and it's a huge amount of equity. But the way I like to think of equity for a typical employee is it's a lottery ticket, right? Maybe something happens and maybe it doesn't. But let's make sure that you have enough equity or enough ownership so that if something does happen, you get a pretty good paycheck out of it. So let's dig a little bit more into some of these concepts, right? What are private investments? I said we're going to focus on private. So there's different forms of ownership that the company may choose to give you. Shares is basically, think about, and I have up a screenshot here of Yahoo Finance, the NASDAQ. But if you get shares in a business, you basically are getting small increments of ownership. And you have exposure to the business because there's a certain number of shares that business has that makes up the whole valuation of how the business is compiled. You have, 100% of the business is going to be spread across different investors, and whoever owns shares is going to have a piece of that business that they own. But there are other ways to be owners. It doesn't just have to be shares. So I could go on Yahoo Finance, or I could go through some, financial trading mechanism, and I could buy a share of ownership in a publicly traded company. Or a company that is private can award you shares or other forms of equity ownership or ownership. I've bolded on this slide options because options are something that most companies are going to use to award their employees. And by the way, if I'm saying anything that doesn't make sense, please drop questions in the chat. I want to make sure I'm kind of slowing this down and covering all the points. But options are typically what your employer is going to award you. And what an option is it's the option to purchase or buy shares at a certain price. Let me say that again, because this can be confusing. An option package is the ability or giving you the option to purchase shares and own shares at a certain price. And so if I'm working at a startup and they say to me, you joined us, we've only done a seed or series A, we're early on our financing journey, they may award those employees with a strike price or the ability to buy shares at a much cheaper valuation than where the company is ultimately trending or going to go to in terms of evaluation. So options are something that a lot of employers are using, but it's not actually you owning the shares. It's actually you having the ability to buy them or exercise them at a certain strike. And we have a phenomenal question in the chat. Do the options expire? Thank you for asking that, Stephanie. So when you are with the employer, you have the option to exercise, right? And I'm going to talk more about the fundamentals, but I'm actually going to dig into this maybe a little bit sooner so that it makes sense. Typically, when you are awarded this options package, there's an initial cliff. The cliff means you don't actually own the underlying, ability to exercise these shares until you get to a certain time period, which is typically 1 year. That's when you start getting ownership, after the 1 year cliff. You also typically have what they call a 4-year vesting schedule. And that means you're not going to have complete ownership after that 1 year cliff, but at the 1 year cliff, depending on the vesting terms or how the ownership starts to be awarded to you, maybe monthly, there will be an event where you start owning more and more of the options that were awarded up to that 4-year mark when you're fully vested or you fully own the options. We'll cover this a little bit later because I know it can be an advanced concept, but to Stephanie's point, do the options expire? There is typically, and I say typically, right, because you really want to dive into the paperwork and you want to understand that every company can define its own plan, its own, cliff, its own vesting schedule, its own terms. But typically, you'll have a certain period of time where you need to exercise the options, meaning you actually need to pay something to own the underlying stock or shares of the business when you leave. Maybe it's 180 days. Maybe it's 90 days. You need to actually look at the paperwork, and you should probably work with a lawyer on this. But being aware that if you are with an employer and they've given you a great options package, you negotiate it, you have all the great, underlying value that they promised you and that is there. If you're not there for a year, guess what? You have no vesting and no ownership. And if you get vested and if you get ownership because you stay more than a year, if you leave and if you don't exercise them after that mandatory period of time, you actually lose ownership. They expire. I know we're covering a lot of concepts. Again, I want to make sure that, we're answering questions. So please drop questions in the chat if you have them. But let's dig a little bit more into some of these concepts. So what I really want you to take away today, and this is something that I've worked with so many smart people. I've worked with people that have, worked at numerous tech startups or startups that are giving them private stock or private options, is I don't want you to think about number of shares. I don't want you to think about how much stock do I have. If you are given an options package or you are given a certain number of shares, what ownership do you have in the business? I'm going to repeat that again. I do not care about the number of shares. You could tell me I have 100,000 shares. You could tell me I have 500,000 shares. That at the end of the day doesn't tell me anything. What percentage of ownership is it? The percentage of ownership, understanding that, and then diving into and understanding the valuation, that tells me something about value. So if you get a package or an offer from a new employer and they say 20,000 shares, an option for 20,000 shares, great. What percentage is that? What's the last valuation of the business? Because if you're not asking these questions, they're probably not giving you much, and they're probably just selling you some story. But if you start asking the right questions, then you can start negotiating and understanding what value do you actually get. We talked a little bit about it, but the vesting schedule. If it's a 4-year vesting schedule and your expected timeline is you're only going to be there 18 months or 24 months, if you negotiate a package that's ultimately worth $200,000 expected based on the valuation today and the ownership that they gave you, and you expect to leave in 18 or 24 months, then maybe you're getting to $100,000, right? You just want to think about vesting schedules. It doesn't completely vest up front. And if you're not there through the cliff, there's no value because you have no ownership. Again, the cliff is typically 1 year. I want to talk for a minute about valuations. Okay, so I have a financial background, and it's something that I just find kind of fascinating because of the environment today. So at a high level, investors, and I'm not talking about the new age investors where, maybe it's just crypto or NFTs, but a typical investor, somebody who's investing in private companies, they're going to be looking at the size of the business. What are the revenues? What's the growth? What's the profit? And maybe they don't care about profit because maybe they're just looking for a business that's growing really fast and actually spending or burning money. What's the story? How big can it get? Right? Is it a big addressable market? Do we think that there's going to be some big unicorn or billion-dollar exit? These things drive evaluation. Essentially, investor interest and demand. I want to tell you a little story. I have a picture of a tulip on the slide. Why? So people can get excited, right? There can be mania. And all of a sudden, there's a ton of value attributed to something that could crash and go to zero if people say, wait, I don't want this thing anymore. And that's basically any asset. But tulip mania is a really interesting story. And this is actually took place in the Netherlands in the 1600s. And it's widely viewed as that first financial asset bubble. And what basically happened was these tulips, or these assets, which I don't know if most people will call tulips assets today, the price on them increased tremendously because everybody wanted them. And it's just showing you that there can be fads, trends, there can be things that happen, dynamics in the market that can push prices way up. This happens all the time. I don't want to say crypto is not worth anything, and I don't want to say NFTs are garbage, but sometimes they are, right? And when I see, and I don't even know the name, but the ape NFT, trading at close to $1 million just because somebody finds so much value in it, that's so interesting. I might not find that valuable, but somebody finds it valuable enough to be paying hundreds of thousands of dollars or upwards of $1 million for that NFT. Again, I'm not here to so much critique. I'm just talking about valuations. Robinhood, if you've heard about it, it's a retail trading platform. And sometimes people just get really excited about something and crazy things happen in terms of stock price, in terms of, how people perceive value. And so ultimately what I'm basically trying to tell you is valuations can be all over the place and there's a lot that can drive it. How do you want to think about it, right? If I were you, and if I'm negotiating or thinking about an equity package, I want to say, great, how much funding do you have? How much traction do you have as a business? Is it de-risked at all? Meaning, is it really risky if we never sold anything? I want to know, what is the likely valuation on this thing? The easiest thing to do to understand a valuation is say, and ask the questions, what was the valuation at the last fundraising event? So the last time that company raised money, where did the investors invest? So there was some valuation that was assessed. Maybe it was $10 million. Maybe it was $100 million, right? But that ultimately tells you, based on the last point or price point that was, as efficient as possible, meaning somebody actually paid money to play, where was it valued? That does not mean it's where it's valued today. We could be in a financial crisis, as we somewhat are today. And, some of the bigger companies out there that were maybe gearing up to go public have gone from, really high valuations and kind of lost some of their valuation given market dynamics. Or it could be an early stage company and they're really just kind of trading or valuing themselves on a story. And so maybe nothing changed. But digging in to understand what is the likely valuation, Then you can start understanding what ownership percentage can you expect? What can you ask for? What's reasonable? And a big question to ask is, what's your seniority and what's your role? If you are on a really early team, first 10 or first 5 at a business, at a startup, you should be getting a good amount of equity. If there are already 100 employees, if you are a mid-level or more junior hire, you're probably not going to get too much. But if you're a senior hire, a VP, or coming in as a CRO or a big role, a COO, absolutely you should be expecting something. But what stage are they? How much have they already raised? And so when you're thinking about valuing the equity, there's so many different questions to ask. So I'm really just introducing some of these concepts today. It's really to get the conversation started. But at the end of the day, I want you to have conversations with mentors, with colleagues, with people you trust. I'm open to it, right? We offer negotiation and also an investing course. But basically, how do you get to a point where the valuation that they're offering you feels good? What is your role? How fast are they growing? What trajectory are they on? Think about the vesting. And when you're starting to think about equity ownership, there's a few ways to get involved. You could actually be an investor, and you could actually write a check. We're not going to talk about that today. We're actually going to offer another webinar in a few weeks where we're talking about getting into angel investing. What is it? How to get involved. But you don't actually have to write a check today to start navigating into equity ownership or company ownership. It could be that you're negotiating that comp package to include equity or include options where you become a substantial owner in the business. You're not able to do it if you don't understand the fundamentals, but at least this starts to get you in the conversation so that wow, I just negotiated not just my $80,000 in cash, but I also have $150,000 of equity or whatever it comes out to, right? You can really up-level or increase the size of what that comp package looks like when you start to understand the fundamentals and how to communicate and ask for what you need. Think about looking at websites like Crunchbase to give you an idea of how much financing is there, right? How big are they? You can look on LinkedIn. Even if it's a private company, you get a sense of how many employees are there. So it gives you a sense of what can you ask for. But I would say if this is your first time, thinking about these concepts or thinking about a negotiation, I would definitely run the concepts by somebody who has a little bit of experience before you go in with a really aggressive ask. But we'll talk a little bit more about negotiating now. So question, can you negotiate an equity comp package? I think just by showing up and just by the title of what we're, talking about today, the answer is yes, but let's talk about it. So at a high level, right, I like to introduce this framework when we're talking about or working through a negotiation. We're going to talk about each of these, buckets in a little bit of detail, but we only have so much time today, so we're not going to cover it all. But the framework that I like to think about with a negotiation, and something I want to mention before we even dive into that framework is, if you are playing a game of poker, it's not about the cards you have. It's how you play against the other players, how you hold on to information, how you understand probabilities, and it's not the cards by themselves. Yes, the cards are helpful, right? But at the end of the day, it's how you play the game. And so let's talk about these different pieces of the framework for negotiation. So first, mindset and confidence. I like to start here because it's arguably one of the most important things for you to be able to show up and ask for the thing. Ask for it with authority. Show up with executive presence if, ultimately what you're doing is trying to get a bigger role or a bigger comp package. And it's ultimately believing in what you're asking for and what you're saying. There's so much we could talk about as it pertains to mindset and confidence, but a few things I want to mention are executive presence. Even if we're over Zoom, are you making eye contact? What is the cadence of your speech? How well are you articulating the things? How do you present? Right? And if you don't have the confidence, and if you haven't practiced enough, and if you don't really know ultimately that what you're asking for is the right thing, how are you going to drive to it? And so really spending the time to break down and understand I'm worth what I'm asking for, or this is what, I need to perform and to show up and to work with this business for the coming years. This is the culture. These are all the things, you have to do a lot of the work so that when you show up, you have the confidence and you can articulate what you need. And information or research is another bucket where if you haven't done the research and if you don't have the data, what you're asking for just isn't going to make sense. You can't negotiate if you don't know the landscape. Do the research, right? Knowing what is the financing? What can they afford to pay you? What should they pay you based on industry standards? What is your role? And maybe research is talking to recruiters and having a few roles so you can negotiate them basically against one another. But research and information and preparation, it's huge. It's critical. All these areas are critical, but I would say the research and preparation to actually come up with the ask. What's realistic, but what's achievable? You don't want to ask for too little, but you want to ask for something that is aligned with what you need and making sure that you're getting enough. Strategy and skills. So I'm a huge fan of understanding human biases, understanding how we present, how we show up, how to actually move the negotiation in your favor. You can use awkward silences and pauses to get more information from your counterpart. You should never give a yes on the spot. Even if you feel like you're being pushed into something, sleep on it, right? Tell them you need time, make them wait. There's so many different types of concepts that you can dig into to make sure that not only are you presenting in such a way where you come across and you kind of steer them in the direction you want, but you want to make sure that they're not manipulating the conversation. You want to make sure you have that time and that presence so that when you do agree on something, you feel really good about it. And a few other thoughts, just to leave you with for strategy and skills, there's so many things that you can practice. You can practice in the negotiation, but I'm a big fan of practicing before you get there. And so even if you're at an employer and you actually don't like that employer, why not ask for something and just get the experience? But there's so much around how you show up, how you present and articulate. I'm a big fan of having 3 bullet points, right? What do you want to get across? And you have to do a lot of the brainstorming to figure out what is the ask, but practice it word for word, what you want to say, so that when you show up in that room or that virtual conference or whatever it is, you can execute flawlessly. There's so much we could talk about in terms of strategy and skills, but something I want to spend a little bit of time on is your why. If you dig into your why, if you haven't listened to the Simon Sinek, what is your why talk, you definitely should. But if you have a strong why, and if you've dug in and uncovered that, you're looking for this comp package because, and this is why you need to work with this company, there's a culture or there's a thing about the business. If you really dig into the why and you match it and you align it with what you're asking for, you're going to be unstoppable. And that's true if it's alignment with, where you're going in your career, what you're asking for in terms of comp. It's so powerful. And so a huge part of negotiating is really, have you done the work to understand, why are you asking for this thing? Why do you need it? And when you do that work, and these are a few, pictures up of my why, people telling me I couldn't do it. Maybe, Me Too moments, losing my mom, things that really drive you. When you really dig in and understand that, it allows you to get to a whole new level in your career, in your comp package. I mean, you name it. And so just a few thoughts, I wanted to share in terms of what my why is today. I shared my historical why on the previous slide, but I'm just really excited to, because of my career struggles and what I went through and ultimately finding that mecca of, I found the thing. I love sharing so that others can find their thing and find, what is their underlying superpower? How do you ultimately dig into and get the thing that you need? And so thinking through and bringing it back to that equity conversation, what are the levers? And there could be more, levers than what I have up here, but levers basically meaning these are the concepts or the things that you want to think about. Can you negotiate? Can you ask for more? Can you change the structure? What is the cliff? What is the vesting schedule? What is your percentage of ownership? I don't want you thinking about what are your shares? What's the share count? I want you thinking about ownership. And if you are looking at an employer equity package versus an advisor or board equity package, those could be two very different things. Let's talk about that. As an employee, you're more execution, right? You're day-to-day. Maybe you're part-time, but you're probably full-time. And so as an employee, you're kind of blood, sweat, tears, planning to be there. Your employer is planning for you to be there for a year plus. Hopefully 4 years, so you get the full vesting. It's typically very tough if you are an individual contributor to a business to negotiate the cliff or the vesting schedule. But you can negotiate ownership. Let me repeat that. If you are an employee, it's really tough to negotiate the cliff or the vesting schedule, but you can most likely negotiate on ownership. If you are an advisor or a board member, that's different. You are not execution day-to-day. You don't necessarily need to be contributing to the business for a year plus for them to really get value. And so oftentimes you can negotiate an accelerated vesting schedule and a shorter cliff. I am typically seeing for advisory and board roles that a 6-month cliff, if not a 3-month cliff, is something you can negotiate to. I'm seeing vesting schedules maybe are 1 year or 2 years. And some boards will want you on for more than a year or two, right? But I'm just sharing with you what I have seen personally and working with others in terms of negotiating their comp packages. And again, you want to think about what are the expectations? What are your expectations? Do you think that you're going to be there through the cliff? And if not, don't attribute, that there's going to be value to that equity. I'm a mathematician. I'm an engineer. So I think about expected values. It's a really great thing to think about. So again, if I've negotiated a $200,000 equity package, but I only think I'm going to be there for 2 years, then $100,000 is the expected value. But is it? Is there actually going to be an exit? Who knows, right? But just thinking through what is the expected value, it's very helpful. So a few more thoughts or comments on, why you might want to think about investing. And again, investing could be negotiating an equity ownership package where you become an investor because of it. It's a phenomenal area. I love investing, right? And I shied away from it for years, but because I care so much about power dynamics, I care so much about influence of really what's happening at the top of the organization, it's not just about the glass ceiling. Do you want to know where real decisions are being made, where the culture is happening? It's the real executive team, and then it's the investors, and it's the board members. And so by elevating yourself and becoming an investor and having conversations around what is happening as an investor, how do I get, a good ownership in the company, or how do I actually invest in companies at some point? You really are able to both elevate, yourself, the conversation, your career, and really impact the power dynamics and what's happening within the organization. Investors really get rewarded. I just want to bring this up as a concept that's really important for you to understand, which is if you're investing versus negotiating an equity comp package, investors get immediate vesting. Investors immediately own whatever they've paid for. Whereas if you have that equity comp package, to remind you, you are most likely getting options and you have to pay something at some point, and then you'll be awarded whatever vested of the package. So maybe this is a little bit confusing, but as an investor, if I invest, I have full ownership on what I paid for or what I invested in. Whereas as an employee, or if you are an advisor or board member and you have a package that's vesting over time, you will only have ownership on what has vested based on the ongoing contributions. So I just like to make that point that investing is sometimes an easier concept if you have the money, if you get there, right? Because you have immediate ownership. You don't have to wait for those cliffs and those vesting schedules. So I'm going to close with a little bit of tips and tricks. I think this stuff really covers a lot of more advanced concepts. And I realize that and recognize that it may be very new for you. I'm loving that I see a question in the chat, which we'll get to in just a moment. But ask the questions, right? Sometimes it's hearing the content. It's diving in. It's letting it sit. And I'll even give you some exercises to help you learn it further. So I'm a big fan of Anything to do with investing or equity ownership, learn by doing or participating. We could talk about the theoretics all day long, but theoretical is only that. So when you actually get to the table and you're having the negotiation, you're having the conversation, there's so much learning to happen in that situation. It's an opportunity for figuring out, what can I ask for? What is too much? What's too little? And listen, private valuations and equity ownership, it's a really opaque or gray area where there's not a really efficient way to understand what should you get. And so there's research, there's conversations, there's probing, it's you asking for things, but it's an ongoing learning journey. And you could for years be negotiating this stuff and still be learning, because valuations change, companies change, figuring out, aligning yourself with the right company for it. There's so much to learn. And so learn by doing and participating. Don't just sit on the sidelines. Learn alongside others. Whether we are talking about getting involved in investing, whether we're talking about throwing around, what are you ultimately going to ask for in terms of equity compensation? Don't do it by yourself. Run it by somebody. Even if it's somebody else who doesn't have a huge grasp on this, if you can't find somebody more experienced and well-versed, does it pass that? Am I in the ballpark? Because if you're not in the ballpark, you might be laughed out of the room, or they're just not going to take you seriously. So make sure, right, that you've had the conversation, you've put the thought in. You might find a website, online if you do some searches, Glassdoor and otherwise. Another website that's great, AngelList. It can give you a sense of how much equity our company is giving out. Again, it's not perfect, but it gives you an idea. The third tip, which is my favorite tip on the negotiation side, is learn, ask questions, and ultimately get to know. Scary, right? Somebody says no or pushes back. It may be scary, but it's a huge opportunity. And you know what that means? It means you didn't leave anything on the table and that you're finding that boundary. Because when you get to know, that means you're pushing and you're learning if you're up for it. And no is something that so many of us are kind of trained not to get to. When's the last time somebody said, you know what? No, I can't do that. You're asking for too much. And so when you get to know, that's when you're ultimately in that space of growth and learning and achievement and getting to that next, higher comp package. One more thought I'm going to leave you with, though, is it's not just about maximizing everything in front of you. I think any negotiation, it's ultimately, if you won and they lost, that's not a great negotiation. You really both want to win. You want to feel really good about ultimately, what did you leg into? How much equity, how much exposure did you get to the business? But you also want them to appreciate your skills, but you don't want them to think, wow, that person just completely, blew us off or didn't value us. You want to make sure that in that negotiation, that you're reinforcing value, but that you're finding alignment. It's not just about winning. It's about getting to a place where you feel good and they feel good. But you basically did the work so that when they had extra money on the table or extra comp that they could have given you, and they were waiting for you to negotiate it, you're actually doing so. So that's what I had prepared in terms of, the short presentation today. I do have a worksheet with some suggested exercises available, and you can visit the link, which is up on the screen, bit.ly/EB-OG3. And that'll give you, an idea of how to dig in further and what else can you learn. So I'm going to open up the floor for Q&A. I'm going to stop the screen share, or actually I'll leave the screen share up for a second. But let's get to that question that just came in. At the board equity package level, who would be the counterpart in a negotiation on accelerated vesting schedule and/or cliff? Would it be okay? Would all the other board members be aware of the negotiation? Okay, great question. So let's talk about board level negotiation. So typically, I'm talking about, in my scenarios, I'm talking about private companies. There is a different scenario if it's a publicly traded company. So again, I'm going to be talking about private companies. Typically, your negotiation around your package, it's really something where you're working with the founder or the CEO of the business when you negotiate it. However, the cap table or the capitalization, or basically all the investors in the business, it is something that becomes transparent to all the other investors. And so what do I mean by that? If you negotiate a huge amount, I don't know, 5% of the business, at some point, right, after you have ownership, after you start investing, people will see your name as one of the investors and how much you actually own. That's called a cap table. So if there are special terms, accelerated vesting, a shorter cliff, I am not aware that the founder or the CEO would have to share that type of information or material. They may choose to, but it's really, I believe, discretionary up to them. Again, we're talking a private company. I'm going to give you an idea or a sense of what you may want to ask for if you are an advisor or a board member. Because 5% is huge. I use that as an example. But a lot of times, if you are helping a few hours a month, maybe 5 hours a month, if the company isn't huge, right, and it's still, let's say, under a $10 million valuation, you may be able to get up to 0.5% of the business. If it's bigger, you may only get 0.1% of the business. Again, these numbers, I'm telling you, are real numbers based on scenarios I know about. But again, every situation is unique. So I'm just sharing a little bit there. All right. The next one wasn't a question. It was a thank you. Thank you for joining. So I know I covered a lot. Again, if you go to the landing page, there is sign up links where you can actually join. We have a negotiation series. We also run an investment group, which is really exciting. So if you want to learn more about valuations, how to think about or how to get involved in investing, even if you're not ready to write a check, we have a path for you. So about 1/3 of our investing members are actually on the learning path, and they're not writing checks. And we're thrilled and really excited about it. We're a community that's really excited about supporting women and diverse audiences. Everyone's welcome. So we actually have some men in the club or the investment group that we're excited about. Everyone is welcome. So that's what I had prepared for today. Again, the chat is open. You're welcome to come off mute if you want to ask a question, but I am going to stop the screen share.